Excellency عبد الرحمن bin Mohammed bin Jabir Al Thani, Chairman of Doha Bank Assurance Company and Managing Director of Doha Bank. His Excellency Sheikh Abd Rahman Yusuf Abaidan Fakhru, Vice Chairman of Doha Bank, Mr. R. Sitaraman, Group Chief Executive Manager, Doha Bank, distinguished speaker, esteemed guests, ladies and gentlemen. Doha Bank Assurance Company has the privilege of welcoming you all for this seminar on construction risk, safety protection, and insurance. At the outside, let me thank all our distinguished guests who have taken time out of their busy schedule and present for this seminar. Before we start, may I request His Excellency Abd Rahman bin Mohammed bin Jabir Al Thani, Chairman, Doha Bank Assurance Company and Managing Director of Doha Bank, to please come on stage and accept. Okay. This seminar is one of the first of its kind in Qatar, focusing on the construction sector from the insurance and safety point of view. We at Doha Bank Assurance Company are convinced that events like this are necessary for sharing of knowledge and experience, which contribute to the overall growth of the industry. Qatar is witnessing an economic boom. We see a series of projects as diverse as infrastructure, education, hotels, manufacturing, and entertainment. Against this backdrop, we thought that a seminar focusing on the construction sector would very much be relevant. Without much ado, let me welcome Mr. R. Sitaraman, Chief Executive Officer, Doha Bank Group, to please take the podium and deliver us the keynote address.
Your Excellency, Sheikh Abdurrahman bin Mohammed bin Jabir Al Thani, the Chairman of Doha Bank Assurance Company, the Managing Director of Doha Bank, Mr. Yusuf Ahmad Ubaidan, the Vice Chairman of Doha Bank, distinguished guests, distinguished panelists, ladies and gentlemen. It's a great pleasure and privilege for me to welcome you all for the first of its kind, a unique seminar which is focusing on the potential risk and the risk fix which we need to articulate in terms of construction industry, which has been performing exceedingly well in the emerging market like GCC. Conceptually, the region has been in the forefront and the flashpoint for the global economics. You must have seen Citibank has been rescued by the sovereign funds of Abu Dhabi Investment Authority over $7 billion US. You have seen Kuwait Investment Authority has placed over $5 billion on the Citibank to make sure Citibank still exists. You have seen Kuwait Investment Authority has placed again $5 billion US to make sure Merrill Lynch stays on account of the subprime crisis. Essentially, Kuwait Investment Authority again placed money in Carly's group. We have seen Istimar is supporting Barnes. We have also seen conceptually Dubai International Capital is placing money across world over, including emerging markets like India. This region has been the flashpoint in terms of economic prosperity. Conceptually, the globe is going through true transformation. The global economic outlook, which you all have witnessed, and a party to the whole endorsement in October 21st, 2007, in the World Bank meeting, IMF meeting, which was pronounced as 4.1%, has been diminishing. It has been contracting over 3.7%. That's estimated for the current context. Perhaps it's due for revision if technically US is going to be declared as a recessionary markets place. If you have consecutive 3 quarters regression in the GDP, and if your purchasing power in terms of CPP is going to go down, consumer purchasing power parity is going to go down, you have no option than to declare US as a recessionary marketplace. Look at the world largest economy, which is going through extraordinary defining phase. You have seen only Latin America within the American context is growing over 7%. Extraordinary fiscal discipline in real terms. The country which was hitherto as a debtor country now as becoming a creditor's nation. The rest of the North American bloc is completely over less than 3% growth prospects. You take Euro, except the Eastern European bloc, which is growing over 7%. Rest of the Euro, enlarged Euro, is less than 2%. Sub-Saharan Africa belt, if you look at it, it is growing not less than 7%. GCC, in its own overall economic trend, if you analyze it, it is potentially growing over 15 to 16% in terms of the average GDP. National income is growing over 20%. Inflation has been the only issue. The headline inflation is going over 13 to 14%, which needs to be fixed. I'm sure regulators are looking at, the government leaders are looking at it. We have seen Asia Pacific Rim is growing over 7 to 8%. We have seen India is growing over 9%. And China consecutive 3 quarters over 11.5%. That's the kind of economic momentum from a global perspective you look at it. In this belt, if you look at GCC in its own wisdom, in terms of surging oil prices, which is over $108, conceptually, there are better prospects yet to come. The sovereign funds is over $1 trillion. It is available today for greater prosperity for the Arab brethren. I was just attending day before yesterday in the 35th annual general meeting of the Arab Union of Banks, and I was having the privilege of addressing as a keynote. We looked at the intra-Arab trade. Everyone is counting on the GCC bloc. If you look at the GCC countries' contribution to the Arab world is over 50%. The total Arab land, if you look at it, 2 continents, 22 countries put together is producing 1.6 trillion for a population of 46.3 million in total terms. GCC bloc, essentially, if you look at the overall prosperity is over 820 billion US dollars with population of 36 million. The total population of 246 versus 36 million, total GDP of 1.6 trillion as against 820. There is 50% of the growth comes from the GCC bloc. We are looking at ways and means of improving the standards for the entire intra-Arab investment and trade. It includes the economic convergence in total terms. In this economic opportunity, in terms of oil and gas, in terms of overall fiscal surplus, in terms of overall current account surplus, there comes an important industry which needs to be protected, relished, and make sure their risks are fixed Their risks are clearly mapped and processed or mapped to make sure they have prosperous long-term endurance. That's the need of the hour. That's why Doha Bank Assurance, in its vision, we thought it's appropriate to bring in first and foremost of its kind. We have always been in the forefront of knowledge sharing. We don't have cheap marketing tools. We live on our knowledge. Our board's vision is to conduct knowledge sharing seminars. We do business quiz. We did sports quiz when it comes to Asian Games. We value the knowledge base is an important tool in a knowledge society like Qatar, which is the order of the day today. World over, today, knowledge societies are being created. That's why you have seen business process outsourcing, knowledge process outsourcing are taking place. Conceptually, if you look at it, that is the need of the hour in terms of insurance industry. We are not yet another insurance industry. We are the first local authorized insurance. We have got a registration under QFC. It is not, a conceptual proprietary relationship. We have our corporate governance. We have, if you look at the framework of our insurance industry within the local market definitions, here is an insurance company which has been licensed in terms of industry best practice. We have our own corporate governance. We have a visionary chairman. We have independent directors. We have technical directors who have come from India as well as Japan. We have non-executive directors who have come from America to build a partnership with the relationship in this marketplace, offer value-added relationships with product. We understand your erection all risk. We understand the construction all risk. We understand there's decennial liability. We understand the workman's compensation. We understand your equipment liabilities. We understand your plant and machinery liability. We clearly understand what we need to bring you as a financial institutions, potentially to value offerings to your relationships. Completely we measure your risk. Clearly we know the market risk under which the construction industry has been generating. We understand the immigrant labors which you are integrating has got potential risk in its own discipline for you to fix. We clearly acknowledge and recognize the operational risk which you are going through in the construction boom. We also clearly recognize your banking requirements in real terms. Construction industry has been in the forefront of the economic inspiration in this part of the world. The total projects in terms of industrial expansion as well as infrastructure creation put together is over 1.6 trillion. This is not ordinary figures. If you look at the world crane total numbers, the equipments which are imported in this part of the world, in GCC 6 countries put together, over 22%. This is not an ordinary number. If you extrapolate the fiscal discipline or the construction progression in this country, Qatar in its own discipline, if you look at it, it's a huge economic boom yet to come. If you look at the overall land space vis-a-vis the total occupancy of the industries as well as infrastructure, still long way to go. If you look at the fiscal surplus which are being generated and being used for the captive consumption in terms of industrial expansion, it forms 14% of the GDP today. It's significant in terms of real numbers. Today, it forms for Qatar 13.8% to be precise as a percentage of your total gross domestic product. So what does it mean? It means potential opportunities are there for us to still ascend in terms of infrastructure creation, industrial expansion. There are multiple projects coming up. If you look at the GCC space as a whole, man-made islands are being created. It is Palm, it is Business Bay, it is waterfront Dubai, it is Kairan city, residential city in Kuwait. We have seen economic city, as King Abdullah's economic city in Saudi Arabia. We have Palm, we have Pearl in Qatar, we have Lusail in Qatar, we have hotel occupancy which are yet to be sufficiently guarded. Hardly we have 9,700 rooms today. There are exponential growth in terms of overall inflow of tourism. As on date, we service over 1 million passengers. Clearly, as tourists, sports tourism is in the making. We are talking about Olympics. Extraordinary drive is there in terms of infrastructure creations. The standards which has been set in Asian Games is just a beginning. Imagine the scale at which the Olympic will be magnified in terms of infrastructure creations. What potential opportunity is there in terms of infrastructure creation? Even the tourism in its own vision, if you extrapolate the numbers, is going to have 26 new brand chain hotels, which will give you almost 30,000 capacity rooms. So it means exponential growth in terms of real construction industry. What does it mean to you in real terms? It means you have business prospects. It also means potential risk which you need to measure, manage and control. Where is Citibank today's reputations? Where is Bastion today? 65 years old company. We had myself, the chairman of Doha Bank Assurance Company, we had lunch together with the vice chairman of Bastions in October. He was upbeat on the organization. Today, potentially it is being rescued by Federal Reserve by putting 27 billion, and JP Morgan came to rescue to purchase at $10. If that is the case in an established economy, what does it mean to you in terms of, these are vibrant emerging economies if you don't fix the risk? We are going through a defining phase in the world. We are going through extraordinary momentum in the world, economic momentum. At the same time, risk, if it is not measured, managed and controlled, you're finished. It can happen to any public institution as well as private institutions. Construction industry has to go through extraordinary risk measurement process. That is precisely the reason we said we will not go like any other insurance company for cheap marketing. We will knowledge share with our partners because we want to be a bank to you which add value in terms of performance guarantee. We have done it in many of our relationships. We have given advance payment guarantee. We have opened up LCs for our construction industries. World over relationships. Turkish companies today, they rely on Doha Bank today. World over, with our wisdom to globalize as a best performing brand today. As an institution, we support the manufacturing as well as construction industry and the struggles they go through in terms of integrating the people, process and technology, deliver values within the standard time. We recognize the importance of you in terms of financial planning. We also have to necessarily recognize the potential risk you have in terms of market, in terms of construction, in terms of performance, to make sure we align the banking and as well as insurance together. Be your partner to plan your financial affairs and then offer policies. It's not to just to dump your policies and run away from the marketplace. That's not Doha Bank Group is today. It is a friend-end partner. That's why we don't run a conventional bank. We run a financial institutions. If you want insurance, it is Doha Bank. If you want banking in its own wisdom, as a prudent professional outfit, it is Doha Bank. If you want stocks, it is Doha Bank. If you want mutual funds, it is Doha Bank. If you are a Turkish company, it is Doha Bank. If it is a Japanese company, it is Doha Bank. If it is a Singaporean company, it is Doha Bank. If it is an American company, it is Doha Bank. It is a global outfit. Not only for, just for commercial existence. Together, we build this partnership to promote value proposition because we understand the potential risk which you go through as a prime industry for the growth as well as visible marketing which you have. It is not easy to integrate an institution that to a construction industry in simple terms. It has got its own intricacies in integrating your people in an immigrant situation which is becoming absolutely acute and difficult in a changing place of the global liberal globalization. Conceptually, you need a partner who can work with you, understand your potential financial requirement, understand your risk measurements, and clearly articulate suggestions and customize the solutions to make sure you become integral part of the success story. It is not you have a policy, somebody is delivering you a policy and you buy it without knowing the value definitions. You need to give it to a professional hand to make sure this is being measured and managed to your advantage. Otherwise, insurance industry by and large, clearly it's an expenditure. That's the perception of every single customer because simply he believes that is to protect him. It is not. As a corporate commitment, as a social responsibility, our vision is to converge the financial service. So we plan your affairs, measure the risk, manage the risk, control the risk. That's why today convergence is very vital for us to relish a financial service, a financial partner who can support you in total construction phases. And that's precisely the reasons we understand your working capital requirements. We understand your advance payment guarantee requirements. We understand every single dimension of your construction phase when you are tendering, when you are performing, when you are executing it, when you are completing your task. That is the reason Doha Bank in its vision and wisdom thought it's appropriate to bring this conference. I've got wonderful speakers today. All are lined up as professionals in their own respects. I got to mention clearly the various policies. That is why Joseph is here. Clearly, Swiss Re has got an extraordinary momentum in world's insurance market space, and here is a speaker who can deliver you. But in the policies and procedures, we want to bridge the gap. I asked Manoj Kumar, who is integral part of Doha Bank Assurance Company. We also have to understand the decennial liability, potential liability within the local market, local regulatory requirements. We've got a wonderful speaker from Clyde, again, to understand and share the experience of Burj, the tallest tower in Dubai, and understand the dynamics of those construction framework and the potential risk alignment. We have yet another speaker from Dubai to make sure we all converge, and end of the day, end of the session, you get a value advantage for our relationship. You feel how you need to measure your risk and then resort to your partner like Doha Bank Assurance. Thank you very much, ladies and gentlemen.
Thank you, Mr. Sitaraman, for excellently setting the tone of this session. Ladies and gentlemen, let me now introduce Mr. Joseph Haddad. He is the Senior Engineering Underwriter in Swiss Re Insurance from Switzerland. He is in charge of the GCC countries, Middle East and North Africa. Mr. Joseph has wide experience of setting up the insurance and reinsurance program of mega project in the region. Please welcome Mr. Joseph Haddad.
Good morning, ladies and gentlemen. First, on behalf of Swiss Re, I would like to thank Doha Bank Assurance for extending this invitation to come and speak before you this morning. Second, I hope that the presentation and the information I will provide you today will bring some added value to your insurance knowledge base. I would like to encourage you to ask questions, but I believe we leave the question and answer session to the end of the presentation. I would like to start with just telling you what the contents of the presentation today is, and first will be a brief introduction about Swiss Re, who Swiss Re is and what we do, the importance of the reinsurance security, the construction engineering insurance covers that we provide. They are the contractor's all risk and erection all risk, and under those covers we have three sections. The obligatory section is the material damage section. The two other optional sections are the third-party liability and the delay in startup. I will also mention contractors, plant and machinery, and touch upon the inherent defects insurance cover. Swiss Re is the world's leading and most diversified global reinsurer. It is the second reinsurer established in 1863 when it started its operation. We offer all types of traditional reinsurance covers for all insurance lines of business. And what I mean by lines of business is the engineering, property, liability, marine, life, and so forth and so on. Our rating is, by the different rating agencies, is AA- by Standard & Poor, AA2 by Moody, A+ by AM Best, and this implies that the company is a strong financially and sound company. Some key statistics from 2006. and the first 3 quarters of 2007. We have an earned premium of 29.5 billion Swiss francs for 2006, 23.9 for 2007, first 3 quarters. Our net income, as you can see, is 4.6 billion, 2006, 4.2 for 2007. Our shareholders' equity is 30.9 million in 2006 and 32.4 in 2007. And last but not least, our combined ratio for 2006 is 90.4% and 90.6% for 2007. A glance about our global engineering unit, the unit which is responsible for underwriting all the engineering projects. Our engineering team is basically made up of multidisciplined engineering underwriters with prior experience in the respective industries in order to allow and help the individuals have a better understanding of risk and better serve our clients vis-a-vis the insurance companies and people like yourselves. Insurance, basically the insurance which we offer is for all simple to complex onshore construction projects, which is our main and core business. We provide specific insurance solutions and services to our clients. And last but not least, our commitment starts with the placement of the insurance, of the CAR and EAR, and ends with the completion of the project, and hence handover. For us, the importance of security, of financial security to the insurance companies is basically we provide the insurance companies with capital relief and we protect their balance sheets. We reduce the volatility of their underwriting result and we allow them to accept more business with the same capital. And what that means, we provide the insurance companies with sufficient capacities in order to insure your projects and help you to sustain your continuation, especially after catastrophic and major losses that may have or may be of significance to your balance sheet and your company. To the importance of the financial security to the insured or to yourselves is also to help you against or protect you against catastrophic losses such as natural catastrophes and major fires, and to mitigate the delay in that you resume the work in case of financial distress. So it is important for you to look and ask for the financial security behind your insurance company, because in times of distress, in times of catastrophic losses, what you need is a reliable partner to be behind you, to help you stay on your feet and to continue with your project and with other projects. I would like to just show you some of the losses that happened and which can affect your construction sites. This is a site in Dubai. As you can see, an excavation pit. This is about 20 meters deep during the excavation, and you see here the break or the collapse of the diaphragm wall. This is located in the Dubai Marina district and happened a year and a half ago, more or less. And this is where this is what happened to the excavation pit. If you notice on the first picture, you see the crane down below, and on the third picture you see the tip or end of the moon, you know, in you know, coming or sticking out of the water. Other familiar sites probably to you is the fire loss that took place also a couple of years back in Dubai, in Doha, and this was a loss that Swiss Re was involved in, and it was quite a large claim. However, our commitment to our partners remained, and we basically paid our share of the claim. Another loss I would like to bring to your attention is the collapse of the Nichols Highway in Singapore, and this is that was involving the construction of an underground subway station, where the highway over that station collapsed because the overburden over the tunnel basically gave in, and that was the result. The CAR, basically the difference between CAR and EAR in a nutshell. Under CAR, we issue the CAR policy for buildings, bridges, roads, highways, airports, tunnels, harbors, dams, mainly when the sum insured value or the construction works are more leaning towards the civil works rather than electromechanical. The EAR answers projects or is issued for projects concerning power plants, desalination plants, cement plants, petrochemical oil refineries, incineration, pulp and paper, and textile plants. The cover, the EAR, CAR in a nutshell, basically we, as you already know, we cover sudden and unforeseen or accidental physical loss or damage that affect or that will affect your construction works insured under our policy. Our liability starts upon the commencement of the construction and or the unloading of the material to the site. Our liability ends when the handover and or the project has been handed over to the owner or the principal. Also worth mentioning that the CAR EAR is a non-renewable cover, but in case the project works are not complete by the original termination or expiry date, or by the natural expiry date of the project, those covers may be extended accordingly. The named insureds are all the parties involved or all the individual companies with an insurable interest on the project, and those which are in respect of their on-site activities only. So, in summary, the principal, the owner, you as main contractors or as subcontractors, the engineers, the consultants, suppliers, etc., which are working on that specific project. The third-party liability section, or this is the optional section which I mentioned earlier, and this is the part or the section which indemnifies damage that may be caused to third parties as a result of the insured contract works under the first section or the material section. And as I mentioned, it has to be in direct connection with the material damage section, and this section may not be given on standalone basis under the CAR and EAR. It either has to be together with the section 1, the material damage, or it will be taken or handled by the other line of business or the other specialties, which is the liability department. Also under the TPL, we can cover the surrounding property. We can extend our cover to cover surrounding property belonging to third parties. Say if you are building a high-rise building, a tower or whatever, adjacent to an existing building which is owned by other individuals, we can extend our CAR cover to for a certain limit to cover any damage that we or our contractor insured may cause to that adjacent third-party property. The second optional section is the DSU, or the delay in startup, and this is basically to indemnify the insured for its profit, and this is emanating from a delay which is caused by an indemnifiable material damage under the section 1 of this policy. So the DSU basically involves one single named insured, one single completion date, one single delay, and that single delay may be the result of one claim or loss, or the result of multiple losses which have taken place during the construction period of the project. One single indemnity, because it's one single delay, and there is a time excess or a deductible, in other words, which will apply. The named insureds under this specific DSU cover are only the owner, the principal, and not you, the contractors or subcontractors, or the other insureds could be the banker or the financial institution lending money for the principal in order to execute that project, or to pay towards the execution of this project. The insured values are basically the annual gross profit, which could either be the net profit plus the standing charges. And what I mean by standing charges are the fixed costs which are incurred in any case, whether there is an indemnifiable claim or not. Or annual gross profit means the annual turnover or the sales that may be generated from the project had the project been completed on time and production resumed according to schedule, less the variable costs such as consumables, power, or in other words the costs which are not incurred if there's a delay or the project did not commence. Another insured value is the increased cost of working, and this is basically the expense incurred in order to mitigate the delay, and this is also insurable if the client requires so. There are two periods involved in DSU. First, the insurance period, which is the construction period, and secondly, the period of indemnity. And period of indemnity means that it's the period to rebuild that project or that section of the project, and it's the time required to reinstate that. And normally this is what you as contractors would provide us with. The extension to the material damage section would not automatically mean that DSU is extended, as I mentioned, for the same reason as the period of indemnity, because this is the period to rebuild that section of the project. And the time excess is the deductible also, which would be borne by yourselves as by the insured principal under the DSU cover. So in summary, the total sum insured value of our under our CAR EAR would be the estimated contract value, the value for the existing property, and this is optional. And by existing property, I mean the property owned by or held in care or custody of the principal and or the contractor. Section 2 is the third party surrounding property, and this is also optional if you feel that the exposure exists and you would like to extend your cover accordingly. And section 3 would be the annual gross profit, debt services, and so forth and so on. The exclusions in a nutshell under the CAR EAR would be the contractual liabilities, or the what falls under the liquidated damages, fines, penalties, force majeure. The claims which are not triggered by an accidental physical material loss. If you remember a few slides back, I mentioned that the material or physical loss has to be an accidental, and there has to be a material damage in order for our policy to respond. Wear, tear, corrosion are not insurable perils, mainly because they are not considered sudden and unforeseen, but they are gradual in that sense. War, sabotage, and terrorism is excluded. The workforce or your employees, which are insured under a workman's compensation or employer's liability or personal accidents. And last but not least, the legal jurisdiction, and this is mainly under the section 2, the third party liability. We exclude jurisdiction in US, Canada, and Australia. The contractor's plant and machinery section is granted either on standalone basis or together with the CAR EAR. And if it's with the CAR EAR, it's basically left to your discretion whether you require it or not. The scope of cover is basically the construction sites or within the construction site boundaries and not outside. We cover basically the accidental damage to the what we call the hull or the structure of these large vehicles. What we exclude under our CPM cover basically the electrical and mechanical breakdown, vehicles which are licensed for road use. So if these vehicles go out on the road, they are not any longer insured under our CAR EAR, but you would have to have a separate motor liability insurance for that matter. Plant and machinery operating underground, and nowadays we see a lot of tunnel constructions, or either for subway stations or for infrastructure pipelines using either micro-tunneling or pipe jacking machines. These are normally excluded, but if they were to be included, then they would have to be dealt with separately. So this is the list of exclusion is longer than 3 items, but I just wanted to touch upon the 3 most important ones. The other cover that we offer under the engineering auspices is the inherent defects insurance. This is becoming quite popular in this region, and what we need to do is to create more awareness about the cover, because there is some sort of confusion about this cover among seeding companies. So the main cover here, or the principles of cover, is the indemnity for damage due to or threat of imminent collapse caused by or arising from cost of the, basically, or what we cover are the cost of demolishing the property and debris removal if there is an imminent or foreseeable collapse that may occur. Repair cost, cost of remedial action to prevent the imminent damage, legal cost, and professional fees are among the items which are insured under our cover. The length of the, or the duration of this decennial or IDI cover is 10 years, and this begins or starts after the completion and handover of this project. The exclusions, or basically what we cover under the IDI cover, are the civil structures only. And this cover is offered to buildings and not to bridges, not to roads, not to power plants, or to oil and petrochemical facilities, but the traditional cover was basically and still to date in the European markets given to buildings. What we exclude under that cover is the all the non-structural elements, equipments, fixtures, any alterations to the structure itself, maintenance, inadequate maintenance, and misuse of the building. If the building is not used as it was intended to be used for, the willful act and willful omission of the insured, fire and other perils which are normally insured under a property all risk cover, or fire and named perils, war, nuclear risk, SRCC, and other political risks that may be defined under that title. If the project is not complete, faulty, waterproof, and weatherproof, however, extension may be granted to waterproofing and weatherproofing, but it has to be specifically required and look into accordingly by the respective underwriters. Subsidence, change in color, texture, and consequential economic loss is not covered under IDI. Before the commencement of the construction or the excavation, we require a technical controller to be appointed to visit the site and to monitor the progress of this project during the construction period, and in order basically to give or to keep the insurers aware of the status of the project during the construction period and what's going on. Their task is basically to study the geotechnical and soil investigation reports, to assist in examining and studying the designs, ensure that the contractor is complying with the local codes and regulations of the building construction. He examines and checks the quality of construction material, workmanship and what have you on site. The checks and monitors progress of works and make sure that everything is going on as scheduled, and he will be present at the issuance of the policy. Now, it's important to make you aware that the technical controller will not in any way interfere with your work, but basically his responsibility and duty is to make sure that you guys are complying with the regulations and building codes of the local market, that the for instance, the progress is going on time. If there are any losses or delays, he would report it to us in order for us to be aware exactly what's going on, but in no way to interfere with your daily work. And his recommendation will come to us as insurers and reinsurers, and the matter will be taken up by the insurance matter with you in order to basically understand what's going on, and to ensure that at the handover and the commencement of the senior liability, everything is or has been done accordingly. Because please bear in mind that the senior or the IDI cover is for 10 years. The insurance and reinsurance companies are taking on liability for 10 years. So we feel that it's part of our obligation and responsibility to know what's going on or what went on during the construction phase, and to basically ensure that everything has been done according to original plans, compliance has been done, and so forth and so on. This brings my presentation to conclusion. Now we are in the question and answer section, so at the end, after the last presentation. Okay, so I hope you all wrote down your questions. If not, please do it now, and I'll be more than happy to entertain your questions later on. Thank you very much, and I wish you a pleasant rest of the morning.
Thank you, Mr. Haddad. Your session was comprehensive indeed and has contributed greatly to our understanding of construction insurance. May I now welcome Mr. Manoj Kumar, Executive Manager, Doha Bank Assurance Company. Mr. Kumar has over 22 years of experience in the general insurance industry in various capacities in several countries. Mr. Manoj is a chartered insurer from Chartered Insurance Institute, London, and Chartered Property Casualty Underwriter from USA. He is also an associate in risk management and in reinsurance from American Insurance Institute. Welcome, Mr. Kumar.
Good morning, ladies and gentlemen.
Good morning.
Thanks for being here. We just heard Mr. Joe Haddad giving us the details of the insurance protection that is available to the industry as a whole, and then the various types of policies that could be taken up as and when we are into various insurance projects. My focus today is on the various issues from the practical point of view, which could affect you as a principal or a project owner, or as a contractor or a subcontractor, or maybe as a designer, consultants, architects, surveyors, and so on and so forth. So what we are looking at today is the kind of issues, not just the coverages, but when we talk about once we are faced with a situation when we have taken a project on hand, what are the various risks associated from different viewpoints, and within those risks, what are the things that could be managed or mitigated, and how we as insurer or reinsurer can come to your rescue. Since we are talking on construction sector, only last week this picture appeared in one of the Doha daily, one of the English daily in Doha. What does this picture tell us? What we can see, what is visible, is some workers perched atop their scaffolding in a kind of precarious situation. They don't have any protective gear. They don't appear to be very well protected from the safety point of view. We do have safety experts which will hear, but my focus is not on safety. That's what I wanted to convey. The very purpose of putting this picture is not philanthropic. We are not speaking from human rights or from a labor inspector point of view. When we see such things, we as an insurance industry, we have a concern in risk management. We want to practice a risk management which is conducive to the growth of this industry and conducive to management of the risk and to minimize the losses. So what can we figure out here? One, of course, because of the situation that this construction or renovation of the project, whatever it is going on, there could be a bodily injury to the worker. They could fall, they could die. The scaffolding itself could be certain things, and there could be a breakdown. This is attached to the existing property which is being worked upon. There could be loss or damage, and there is surrounding property. What if something falls down, a piece of wood which is not very well tied up, or a piece of steel? So there is a passerby. There could be a huge amount of liability losses. You could be dragged into the court. So what we are looking at is basically managing the risks. Risk management is a huge topic and a big subject. We have experts in Mr. Douglas Nielsen who will be talking about risk and convergence later on. What I have done is picked up only a portion of the entire gamut of risk management, which is straightaway related and connected to what we are going to talk about. So if we talk about specifically the techniques that is available at hand for us, is basically risk control and risk balancing. And how do we control our risk? The easiest way is to avoid the risk, that is risk avoidance. If there is a risk in construction industry, we don't take up this job at all. I don't think that is a feasible option. Then what we have? We have prevention of loss. We have to take measures, make efforts, by which at least we can try to prevent the losses from occurring. Which may happen, may not happen. It's not in our hand. That's where and why the insurance exists. Then what we have, loss reduction. Once the risk has happened, still we have a duty and we can still do certain things from the losses escalating further. So there is a loss prevention measures has to be in place which can control the losses post a claim, post a loss has happened. And then of course contractual transfer, which all of us are aware, like as a principal, you have all these losses, which is theoretically possible in nature. So you transfer that by a contract which you sign with the contractor. So the risk of a principal is transferred to the contractor. That is by way of risk transfer. So this is a risk control measure. Now whatever you do, risks are bound to happen. That's what the accident's definition is. It is unforeseen, fortuitous. So risk will happen, whatever you try to do. So what do we do then? We try to manage it. And how do we do that? By financing it. Now financing again could be two ways. One, you retain the risk. You say that we are huge, we are a multi-billion-dollar company, so whatever losses happen, we don't care, we don't bother. So you finance that risk internally. By way of either retaining, you say that I'll retain whatever comes to. There are various things. I will not get into that. It could be balance sheet retention, it could be off balance sheet retention. And then that along with the transfer to the insurance company. So you transfer either full or in part that risk to an insurance company. So what does it mean completely? So you have on one hand a risk control that is essential and integral part of the risk management process for any risk that we are talking about. Along with that, the combination of risk retention and risk transfer. Risk retention, by that I mean the deductibles that you have in policy. So you have to manage and maintain and reach up to an optimum level where you retain certain risks and pass on the rest to the insurance company, and there has to be an optimum level to be achieved by which you not only inculcate the practice and habit of good risk management, but also you try to reduce the premium that we are going to charge you. Once we see that retention levels are high, it means you are prudent, you are following due diligence, and then we'll be very happy to associate with you in insuring your policies. Coming to the project itself, what are the parties? We all know, and that's what the focus of this seminar is. We have project owners or the principals. Then you have main contractors and subcontractors. We have architects, designers, engineers, and allied associates. And then we have a very important integral part of the whole combination, that is lenders, which in most cases are the banks, and everyone has a stake in any project, and particularly in construction when we are talking about. We'll briefly try to identify by the ownership, by the segment or by the parties of any construction project. So if we talk about the contractors or subcontractors, what are I've just tried to identify, this is not exhaustive and there could be more to it, but what are the main risks that a contractor or subcontractor is faced with? It could be material damage. The contract itself, which could or would include contract works and including temporary structure, whether or not it is part of the contract awarded. Then plants and equipment. Again, this may not be part of the value that a contract value indicates, but you could have your own equipments coming onto the site and all. Then the storage, it could be on-site, off-site. For large works where fabrication is involved and all, you could have storage at other remote sites. If it is a long project, you could have raw materials and so on and so forth lying at some other place. So you have to make sure that is also taken care of. Damage to existing property has been discussed, and surrounding property also. Then loss of manpower, as we saw in that picture, there could be bodily injury or whatever to the manpower, which is our workforce that is being employed to do this work. We have transit risks. When the consignment or imports, which are an integral part of construction, it could be equipments, it could be machinery, it could be spares which is being brought in from abroad, there is a project cargo risk. And even within the country, have we ensured, if you have a warehouse, as we talked about off-site storage, if you have a warehouse from where it is coming to the construction site, have we made sure that the transit from the warehouse to the construction site is taken care of or not? And then obviously we have a reputational risk. So I'm just identifying the risk. All may not be insurable, and there could be certain things which has to be managed. But if you have repeated losses in a particular structure, it's a huge reputational. The property may not be saleable in due course. Identifying the risks for architects and designers, it's basically your professional advice. Negligence, whether intended or unintended. Then the design itself, you think you have done the right job, but eventually it is proved that it was defective. And then errors and omissions, which is pretty normal. Anyone is entitled to make mistakes. So for which you could be dragged later on and asked for compensation. Then we have project owners. Everything that applies to contractor applies to the project owner. Actually, the risks are essentially of the project owners, which are transferred by contract to the contractors. But they have some more things. Contractor, once he has completed his work and gone away, then you have no lien on him unless something has been stated in the contract. And that's where Joseph brought in the IDI cover, inherent defects liability, which otherwise is also called the decennial liability, which talks about the inherent defects. The project has been taken, design has been agreed, it has been constructed upon, handed over, contractor goes back after 5 years to identify defect by which either the structure collapses or it has to be the decision taken that to avoid or minimize further losses, it has to be demolished because the defect was there in the design itself. So there is a decennial liability cover for that. So as a project owner, you are exposed to all lots of things. In addition, there is a consequential loss. So if there is a delay in the construction of a particular or a particular building, which could be just a part of a series of project shop. So delay in this could delay in your subsequent business. You have planned a factory. You have had a business plan where you see that next year I will do maybe $50 million worth of business. The whole project delayed itself so that you have not been able to start the business. So there is a loss there. So there is a huge amount of consequential loss and because of delay in startup. For whatsoever reason. And then you have liability risk, which again, if you are not as a project owner adequately or properly insured, would come back to the principal and owner. Then we have a risk, being a partner to the construction secretary as a lender, the banks or the lenders, they have the risk, their asset is at stake. So eventually if the claim is not payable because of inappropriate cover taken or insufficient cover taken, they run the risk of losing their capital or the asset that they have given to the contractor or to the principal. Despite the fact that the lending from the bank side would have been done based on the expertise or the experience of the contractor, and proper analysis has been done about his background and financial solvency and so on and so forth. Yet there is a risk in the industry, and could be market risk. The prices of property could go up and down, and that could affect the construction itself. I mean, there could be intended or unintended slowdown. There could be shortage of raw materials. So that could again lead to the delay. And then you have industry risk, something which is more of global in nature and that all of us are facing in the form of subprime crisis, which has become global. Now, having briefly seen the risks associated with various project owners, now let's see how to mitigate that. What are the components if we talk about project insurance? By project, I see the entire construction industry from A to Z. So what are the things available at our disposal by which we could mitigate or reduce our losses by transfer of risk to the insurance company? So essentially, what are the policies available? Mr. Joseph just discussed CR, that is contractors all risk, EAR, that is erection all risk, TPL, that is third party liability, and DSU, that is delay in startup, which in other words is also called consequential loss. So we have discussed this. We have professional indemnity, which is a policy available for the designers, surveyors and engineers who are basically into the consulting advice and design to the project. Then we have inherent defects. This eventually falls back to the principal, and these defects could come even as late as after 8, 9, 10 years. So this policy is a 10-year policy which covers the inherent defects in a particular structure. And then we have residual and related risks, and consequently insurance policies are available for project cargo, which is a very important subject. We'll discuss what that is. And then workers' compensation, as we saw, and then also the motor fleet policies. There is a strong correlation. We think motor policies were pretty simple, pretty easy, but there is a very strong linkages with the construction site and construction risk, and sometimes the claims may not be payable. Now, the focus, as I said, is to discuss the issues rather than on the policy itself. So the coverage, all we know and has been discussed. So I'll move on. The CR policy covers all possible material and third-party liability damages. But what are the issues? One of the issues is when you as insured, as contractor or whatever, when you insure the policy, the general tendency that we have seen is the project value is the sum insured. But is that correct? There is much more to just the project value. There is more at risk from your point of view or the principal's point of view. What are those? The contract price, of course. Whether or not that includes contracts, plants and machinery, in most cases not. But at the construction site, if you have your own equipment, that needs to be taken care of, and that needs to be combined with the CR policy. Principals existing property, it's optional, as Joseph also said. Temporary facilities, please include that. You also have provision of inflation, so we can accept up to 5 or 10% or something, could be agreeable. So if you think that if there is a loss down 6 months or 1 year, and by that time the cost that I have insured would go up, so there is a provision for inflation also. Wherever VAT is applicable, value-added tax could be put into that. Free issue materials is very important, and we invariably come across the cover request where principals, they have provided free issue material, and the contractors either they have not insured or they don't want to insure. But you have to make sure whose responsibility is that to maintain that free issue material. If it has been provided by the principal and if it is under your care and custody, and something happens to that, or something happens because of that to the third party, who is responsible? So our advice is to take this into account when you insure the policy and discuss with us. And this debris removal in the course of construction, if the debris has to be removed back and forth, that also has to be added to the sum issue and premium applied. Then of course third party liability, generally what we see, unless forced upon, people come up with 1 million real limit, or sometimes 2 million or 3 million. We also have to see and discuss internally and then with us what is the adequate sum issue for third party liability. You think 3 million is okay, it may not be. Some of the things, the equipment which is working out there, their length is so much that it could go on to the other side of the road and damage certain other things, whereas you have not foreseen that. You are just seeing your own property which is being worked upon. So it's very essentially important to think what is the ideal limit for sum insured, for the third party liability sum insured, and very large limits may not be easily available also, but it has to be worked upon and discussed at the time. We are all talking about risks, exposure, and how to mitigate, and what issues you should be aware about when we are talking about insurance. Then the other issue is the contractor's plant and machinery policy, where you have to make sure whether the plant and machinery that you are bringing onto the site, and obviously all are reputed contractors, so you have repeat works, you have multiple contracts during a year, or same machinery are moving back and forth to the different project sites and all. So whether this has been insured under a particular project or you have an annual policy, you have both the choices. Up to a certain percentage, it can be covered under the CR policy, but if you have huge amount of this thing and you are not sure which equipment is going to be there at which site, it's better to take an annual policy, which is easier and cheaper also. And then the sum insured on the CPM, this again is another area of dispute, is it should be on the replacement value. So if you are supposed to buy an equipment, even if you are if it is 5 years old, the value to be insured is the replacement value, which is a law, which is a rule in this kind of insurance. So it has to be insured at the replacement value, even though in the event of a claim, we'll pay you the actual price at the depreciated price. That's natural. And then another important thing which I talked about, motor fleet and all. We have got equipment which is running on its own steam, on its own power. So many cases, in many times, we insure such equipments under motor policy. Now that motor policy can cover the bodily damage to the vehicle, maybe at site also. But the third party risk is only road risk. So only on the road, if it has hit someone, that claim is payable. But if there is a third party loss or damage arising out of that vehicle, including equipment, at the site, that third party may not be payable because motor policy excludes on-site third party liability coverage. So what we can do, we can provide, it's called a tool of trade extension. Such policies could be converted into engineering policy, and we can give you on-site coverage also for the claims arising out of those equipments. That's very important. And then we have various other issues like terrorism cover. People don't ask very often, but it's very pertinent and it is available. Till 9/11, this was automatically included in part of that. After that, it has been excluded explicitly. So therefore, if you want, we have to include this by paying additional premium, and it's again straight away not available, so you have to give time and you have to manage and discuss. Off-site storage is discussed, and incidental inland transit also are discussed, back and forth from the warehouse. Then time overrun. Invariably, if you have agreed for us to issue a policy, say for 2 years, plus maintenance period, and that completion of the project is delayed by a couple of months, so you have to make sure that the insurance company is informed appropriately, properly, and adequate premium has been paid. You could also do something like automatic extension by payment of additional listing. So that protection has to be, we have to make sure that protection is there in the policy. Just in case you forget to inform us that the schedule is delayed and we need to extend that policy. Then we have got variation orders, very important to inform us. If there is any change in scope or increase in sum assured and so on and so forth, it's very important to inform. Otherwise, in the event of a claim, there is a problem. We also have issues like earthquake zones or seismic protection. Now today, it's a well-known science that the risks go by the seismic zone. It's a fairly predictable science as to where we have more chances of earthquake. So we have technology available today where you could have inbuilt seismic protection when constructing a building. So why not use those things, and once you come up and tell us, we and our insurers will be very happy to give you a preferential rate when such technology is being used in the construction. And similarly, while working out a project plan, the weather considerations have to be taken into account. I'm sure you do that. For example, if it is the extreme rainy season, now we are also exposed to rains, which was not the thing. So open walk should be avoided. The road and trenches should be avoided. And again, we are there to cover to unforeseen things, but because of the climatic changes, those things have happened. Now, it used to snow in UK in Christmas time. Now, last week it was snowing. So we don't know. If it is supposed to rain in July, it might rain in April. So notwithstanding that, we have to make provision for all these things when we plan and execute our projects. The other issues are this fire prevention and fire protection. Last week there was an article published in Gulf Times, a Doha newspaper, where they surveyed, identified, analyzed and researched the fire losses taking place in Qatar in particular, and what they came out with. Most of the losses are occurring because of use of substandard electrical wirings, inadequate training or unskilled laborers that we employ because they don't know, they don't understand the safety things. Then most incidents have occurred during waterproofing and insulation works. Heat insulation used in the walls are highly inflammable. And basically, it's again, we go back to the technology or material, what material we source. And then what type of insulation protection we are doing. All towers to have fire lifts, pressurized units in the case of fire, so that alternative is available. And commencement of electrical work only should happen after the civil defense work has given a clearance certificate. And then very frequently the communication of the labor force, because now this is we are a multilingual society in Qatar in particular. We bring people from Philippines, Nepal, India, Bangladesh, so on and so forth. So people, unless they understand each other's language or they are trained or given this thing, they would not understand the instructions that is passed on to them. If we have a supervisor or site inspector who is speaking English or whatever language, and if the labor doesn't understand that, there is no merit. I mean, you can't use such labor force and all. So therefore, you have to integrate, train and educate them and make sure that the communications are extremely clear. This is another slide again from Gulf Times. What it says is number of accidents increasing. As against 66 in March 2007, we had 113 in Qatar, the accidents in the construction sector. It does not say that we are very bad in this management. It probably indicates that the number of projects have come up. There is much more projects, but important is to analyze and realize what is happening and what we need to do. And here, if you look at the fire incident alone, in January 2008 was 82 as against 57 in 2007. And if you look at the pie chart, the colors are not extremely visible. Other than the unidentified losses, the largest is coming because of short circuiting. That is 13% in 2007, which has become 17% in 2000. No, it was 17% in 2007. Something wrong. This is 2008 on the right hand side. So it has become 17% in 2008, and there are other regions which are highlighted. Then coming to professional indemnity, as you know, as we discussed, professional indemnity is for the basically contractors, surveyors, architects, designers, and this policy intends to protect them against the professional error or judgment mistakes or unintended negligence. So what it will protect you against is basically professional errors, innovations or negligence. even the loss of documents, if that could result to further losses, could be covered. Could be breach of confidentiality, which a principal or someone else claims that because of your breach of confidentiality, my trade secrets are leaked, you could be dragged into a court. Breach of copyright, this again has to be unintended, and liability arising out of one of your employees, if he does something by which the project gets a loss, that also could be covered. What are the issues? For a professional indemnity policies, the most important thing is the retroactive date. Now, retroactive, what does it mean? Retroactive date means when unlike CR policies or any other fire or property policy, you have a very specific start date, end date, 365 days. Whereas such policies, because these are liability, long tail issues, whether or not you had an existing policy in place and you are changing the insurance company, you could set the retroactive date, which again is based on, it could be claims made, meaning when the claim is being made, notwithstanding when it occurred. So if an incident happened 6 months ago, which you are not aware, so under claims made policy, if it is reported today, that is claimable. As against if the policy is issued on a claims occurrence basis, so the policy, if the policy was with some other insurance company and it was issued on a claims occurrence basis, and even if it is discovered after 1 year, it has to go back to the previous policy. So you have to be very careful when taking a policy from whichsoever insurance company to make sure that you understand what the occurrence retroactive date has been mentioned, and you have to discuss and analyze. When it is continuing, there is not much problem. Even while changing, there is not much problem, but we have to understand and be sure that there is no gap in the coverage. If the risks are coming, it should not be, it should not be blank. If there was an earlier policy and you have taken a new policy which is just claims made and or retroactive, so then it will not pay the policy, the claims that has occurred on the previous policy. So it should be discussed. And same way there is extended reporting. So if you are taking a policy, you can always opt for the extended reporting of up to 6 months, even if the policy has not been renewed or the policy has expired. So the claim occurring on that policy could be taken up till 6 months or 1 year later. Then punitive damages are generally not covered, but because of extreme and ultimate pressures, some of the reinsurers globally, they have started taking it in bits and pieces and in a very limited amount. And another issue is whether you want, sometimes principals force designers to go for a professional indemnity policy, and then we receive requests to issue them a professional indemnity policy only for a particular project. That is a problem. Not really a problem, but when you come up with a particular project, it's a high risk from our point of view. So what we would prefer is, if you are in the business continuously, you should have an annual policy and cover all the projects that you are working on. So it's easier and safer for you, and it's cheaper also. Annual policy anytime is cheaper than the project policy, and project specific policies are generally not very easily available. Then we come on to workers' compensation. I mean, it's plain and simple. This insurance follows basically the WC law of different countries, which is again part of the labor law, and clearly stipulated the scale of disabilities and so on and so forth. And it follows the court award, and you could have settlement after the award or before the award, but it is basically statutory in nature. So whether or not you have an insurance, you have to pay this. So therefore this insurance covers as the statute says. So it follows basically the law, what it does. However, the issues are whether this WC or workers' compensation policy is intended to cover only the work time or work related injuries. But if you care for your employee, you could ask for a 24 hours cover, which we will be very happy to extend that. So it could be extended to the 24 hours cover, obviously by paying a additional premium. Then we have occupational diseases which are listed again as per the law, and then it's not necessarily have to be a bodily injury or death or something like that. If one of the diseases has been contracted in the course of employment, which could be attributed to that kind of employment, that is also covered under this thing. And then another most important issue in a workers' compensation policy is, even after you have paid a claim to an employee under the court award, as per the WC Act, your liability does not end. For example, if a worker is injured, death has taken place, and court awards say 50,000 riyals, and you have paid, but that is as per the WC law. He has a recourse to go to the civil court. So therefore, under either common law or the law of torts, civil court can take up he can say that fine, I have got 50,000 as compensation, but my actual loss is much more than that. I deserve 1 million here because I have suffered this, I have mental trauma, I have this, my family is suffering, so on and so forth, or the family could claim on that. So the over and above the WC, the court can award additional liabilities, additional award on you to pay for that. So this policy can further be extended to include, or a separate policy can be issued, which is called employer's liability. So that employer's liability covers you under common law, whereas WC covers you under the statutory WC law. And then we are coming to the final stage where project cargo issuance. This again is less talked about, but from our point of view, in this era of construction boom, particularly in the Qatari economy, we are seeing very, very large size of equipments or related cargo being brought on, which goes up to $50 million per consignment, which is pretty unusual. And why this will happen? Because we are doing on a turnkey basis, the contracts are being done on a turnkey basis where specialized things are being done. So you go and award a particular machinery which is not available off the shelf. So it is being built and created, which could take 1 year, 1.5 years, 2 years. It is specifically built for you, which is heavy, which is large, which is very expensive, and then it is being imported in to the country. So because of the very nature of that thing, it becomes so important that in the course of transit, if something happens to that, so we are not talking only about the loss or damage to that particular thing. If that is damaged, so you have a blackout period of another 18 months or 2 years, as much time it takes in the remanufacturing that particular unit coming onto that. So this is very important and it needs to be discussed. Similarly, a project cargo, when you are negotiating such cargoes related to the project, which is invariably large machinery and specialized items, what we have to look at is unless it is covered up to the warehouse. If you have signed up a deal with the exporter on a CIF basis, so the insurance terminates at port. Whatever risk you had on sea, you have equal amount of risk in carrying that cargo from the port to your warehouse even, or to the project site, even if it is just 1 kilometer away, because of the nature and size and value involved. So either our advice is either negotiate the CIF or whatever purchase order is there on a warehouse basis, or exclude insurance at all and take the insurance locally here in order for you to cover the risk completely. Otherwise, the problem that we face is you have a consignment which has arrived at the port and you want us to insure that risk from the port to the warehouse. We don't know what has happened inside, whether it is broken or not broken. It cannot be opened up at port and we cannot be surveyed. Now, if that is carried over and after 1 month you open up that thing and you say this is damaged, whom will you claim? Whom will you charge against? Whether the original insurance company or the insurance company which has given will and transit over here. That's why insurance companies are extremely reluctant to cover that risk, and that's why we call that as a tail end risk. It's a very complicated thing. So please discuss whenever you have confusion. We'll be able to help. Then there is a 50-50 clause where in the event of a claim, if it is not clear, as in this example, whether this liability falls under this policy or that policy, whatever it may be, you will be paid only 50% of the damages. So there is more at stake from the insured point of view. And then the other issues, I mean, as we see and we saw that what are the critical phases in a cargo, in a project cargo. It is being fabricated at some stage. So from where when it is being transported to the port at the country where it is being done. Then loading, these are very critical moments, and generally what is advised that specialized risk managers from your own company goes and stays there and sees everything is being done, or you have to hire specialist surveyors who do work on your behalf that it is being done in a proper way, and so on and so forth. So as we could see, even if the cargo is worth just 30 million, if there is a loss or damage, and because of the delay, the combined loss could be in excess of 200 million. So therefore it has to be handled very carefully. And finally, this is trying to summarize, all that we need to look at is we have to have a comprehensive project plan which should look at not only the immediate closure or completion of the work, but should also look at various issues that all we have discussed. apply the appropriate risk management techniques. You weigh how much you need to retain, how much you need to pass on to the insurance company, or by contract you need to pass on to your own subcontractors. That is another issue. Deploy the latest technology, whether seismic, non-seismic, even equipment, other things, the technology available at our hand that is more safe also. So deploy the latest technology. Hire expert risk managers. It's not an area in particular which is highly risky and vulnerable. This thing. Please hire good risk managers who have risk management background or insurance background who will help you. And then inculcate and enhance the safety culture. Thank you very much. We'll have question and answers after the last session.
Thank you, Mr. Kumar. It was really interesting to know the various issues linking insurance and the construction industry. I now welcome Mr. Douglas Nelson, Assistant General Manager, Risk Management, Doha Bank, to share his thoughts on risk and convergence. Mr. Nelson has in the past held senior position with Deutsche Bank and is a well-known authority on risk management issues.
Ladies and gentlemen, good morning. Risk management, risk convergence. Modern risk management dates from the 1980s, but a combination of extreme conditions in financial markets, linked with an explosion in computing power, opened up opportunities for running stress scenarios. While financial models are only as good as the assumptions, and can all too easily become unstuck when too much blind faith is put in them. The current global credit crisis is a prime example. They provide considerable value in highlighting potential risk areas and weaknesses. Risk management continually challenges its practitioners to justify and articulate their concerns. When performed at its best, it is solution-oriented, creative, and innovative in improving the risk profile of the organization and in finding elegant and effective ways to structure risk. Risk management has four roles: risk identification, risk mitigation, risk diversification, risk pricing. Regulators and rating agencies continue to demand increased transparency and more detailed disclosure, with shareholders increasingly demanding answers on financial and reputational concerns. What's a classic approach to risk convergence? In fact, what is convergence? Is it just a buzzword, or does it mean anything? Well, one definition that makes sense is the establishment of an integrated approach and consistent set of processes that reduce redundant risk and control activities, eliminate duplication, and drive down costs. The risk operating model across many financial institutions, many companies, involves three parties with interconnected roles. The business line, the risk owner and risk taker. In construction, this could be an agency planner, an engineer, a construction manager, depending on the point in project development, or it could be a private sector contractor or partner, depending on the contracting method and risk allocation. Risk and control functions, risk management, compliance, the IT risk guys, and the third group, internal audit, confirming that sound processes and corporate governance are in place and functioning well and as intended. The route to convergence. Define and communicate the vision. If you don't know where you want to go, you won't get there. Establish a responsibility matrix. Be very clear. Who does what? No duplication. Once done well is enough. Seek cooperation from everyone. You need a lot of buy-in. Test your hypothesis. Be clear what you need. And finally, make it a reality. To be effective, risk convergence requires measurable goals and a willingness to adopt and share best practices. The target? A flexible, systematic, efficient and sustainable risk management framework. The construction industry faces many risk issues in this region. What with rising commodity prices, strong competition, finding quality subcontractors, and increasing pressures to deliver projects on time and on budget. Clearly, you have to be prepared for rising risks in every new and current project development. Risk can sneak up when you least expect it. So how are we handling risk management in Doha Bank? Well, as a first step, we're re-engineering our approach to risk management to make it more transparent, more effective, encouraging a professional risk culture across all businesses, working with our business colleagues on how we can best address, measure, and price risk. Quality credit assessment, well-honed business judgment, and appropriate structuring mean we position ourselves to take well-informed risk decisions. Installing a new process, starting with a beefed-up credit rating system, linked with a more focused use of financial data on costs and revenues, leading to devising an economic capital model. The ultimate objective, to use our capital more intelligently, more profitably, and more effectively at counterparty, product, and portfolio level, and to enable us to respond quickly and flexibly to changing circumstances. Strengthening risk management's role to establish processes that add value, and work with business in optimising the use of credit appetite and of capital. Our approach is to structure transactions to mitigate weaknesses and make them feasible wherever possible. Properly priced deals, even those with high risk elements, can be very acceptable, provided there is no undue concentration. That's when the US subprime housing finance market became unstuck. There were a huge number of individual borrowers, but no genuine diversification of risk. Most borrowers had similar risk profiles and were all vulnerable to exactly what happened to a falling residential property market. A well-balanced portfolio has a structured mix of business across all risk buckets, well evaluated, well spread, well priced, and well managed. Creating a strong voice with the industry regulators and the rating agencies on risk management issues, contributing to raising industry standards and transparency, including a portfolio management approach to our business strategies and setting out trigger points for early warning and remedial action. We've clear-cut different but complementary responsibilities on the various components of risk management: credit risk, the approach, thorough credit ratings with quality credit research, economic capital model, development of market-based credit pricing tools, transparency and consistency on credit standards and decisions, and an independent risk process. Financial risk management is simply an extension of sensible prudence and foresight to imagine where we may be vulnerable in managing all market risks, interest rate risk, exchange risk, equity risk, and commodity price risk, and asset and liability issues, and to be watchful and proactive. Operational risk, and IT risk use insight from past experience of what went wrong to identify, measure, and manage areas where the organisation may be vulnerable, investigating and learning lessons from losses or near misses, and making reasoned judgments and scenario analysis on what could go wrong. This includes identifying and highlighting areas where we're at risk in policies, processes and systems, and where we're vulnerable to external events. Increasing awareness within business and services on the need to proactively identify and address potential operational risk issues, and evaluating risk and mitigants, identifying the costs, and proposing the course of action. Changing processes, arranging appropriate insurance, that's a plug for you, Madam, building new solutions. By doing that systematically and intelligently, we intend to keep raising operational standards. Ladies and gentlemen, we are risk managers. We make no claim to be soothsayers. We have no special gift for reading tea leaves, and no crystal balls with the power to predict the future. But we can and do protect the organisation with the flexibility to look critically at risks, ask searching questions, and zero into issues. That is our strength. These are all areas where we're currently focusing. By raising standards across all areas of risk and shaping this into an integrated and convergent approach to risk management, we believe we can continue to add real value and avoid duplication of effort. There's a dangerous world of potential risk out there. We have to keep on top of it. Ladies and gentlemen, our risk culture is continually evolving. We believe our structure makes sense. The concepts are equally valid across different industries. Managing risk is a real challenge. We need to address it with confidence, with flair, and with excellence. Thank you.